Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hey guys, it's Robert from the College Investor here, and today I am going to talk to you about an interesting situation when it could make sense to use a Heloc or home equity line of credit for your student loans. So your home's equity can be used not only for home improvements, but it could also be used for paying off your student loans. When it comes to using your home's equity, Helen Huang, Senior Director of Marketing for SoFi's mortgage products, says there are plenty of benefits. Equity is a tool for improving your financial position. Use it to pay off high-interest credit cards or student debt, or to make high-value improvements to your home, like remodeling a kitchen. Banks need to know that you can use the equity responsibly. So, to utilize your home's equity, your bank or mortgage company could create a Heloc or home equity line of credit. You can take draws on this line up to the limit, and once that line has been created, you can continue drawing on it without the need to fill out an application each time. Rick Hard, a TD Bank Senior Vice President of Consumer Products, notes that a Heloc is typically a 20 or 30-year term. A lot of things might change over that time, but this allows a customer, without having to spend more money for closing costs or fees or going through another application product, to continue to meet their borrowing needs over the entire life of their relationship with the bank. So let's talk about when it makes sense to use a Heloc to pay down student loans, along with a few financial factors to consider. The first off is that realizing a secured versus an unsecured loan. Student loans are technically unsecured loans, even though I kind of hint at the fact that student loans are secured by your earnings, but technically they're unsecured. This means that you didn't have to put up any collateral to back up the loan. Instead, the loan is backed by the government. This is unlike another type of popular unsecured loan, credit cards. Credit cards are backed by nothing but your promise to repay them. If you're not able to pay your student loan, since there isn't any collateral except your earnings, you end up having your wages garnished or tax refunds claimed by the government. So it's important to note that student loans are backed by you. In contrast, a Heloc is backed by your home, as is your mortgage. When paying off student loans using a Heloc, you aren't really paying off the loan. You're simply transferring it from one account to another. So this is important to note because if something goes wrong and you can't pay your Heloc, your home could potentially be in jeopardy. And in a worst case scenario, you could even lose your home. Assuming that you can make on-time payments, if the Heloc has a much lower interest rate than your student loan, you could potentially save a lot of money in interest. And that's one of the main advantages of using a Heloc to pay off your student loans. But keep in mind that by transferring your student loans to a Heloc, you lose any advantages that could be offered by your student loans, such as student loan income-based repayment options, forgiveness plans, and more. So, there's different things depending on how your mortgage was opened. You might already have a Heloc. You need to check with your mortgage company. If you don't have a Heloc, you'll need to apply for one. And if you're applying for a Heloc with the same company who has your mortgage, the application process is typically pretty easy. You can also try for a lower rate Heloc using a different company, which might require more paperwork, but if you could save a lot of money in interest, it could totally be worth it. If you can secure a fixed Heloc that has a lower rate than your student loan, it is worth the consideration of using a Heloc to pay off your student loans because you could possibly save thousands of dollars in interest. In 2017, it could have been definitely worth it because you could also write off the interest on your taxes. However, with the changes in tax laws, you're not able to do that with a home equity line of credit any longer. Another alternative to a Heloc is to use your home's equity through a service like Point. Point Financial allows you to sell equity in your home, in which case you could use that equity money to pay down your student loans, which is one of the use cases we discussed when we were reviewing Point last week. But moving a student loan to a Heloc does mean that you're increasing the risk to your house. So if you default on your Heloc, your bank could foreclose on your house and you could lose it. But if your financial situation is robust enough that you can make your payments every month, you know what? It could save you a lot of money. So it's something to think about. You could take that debt and that burden off your income and put it into your home. You still have to make those payments, but you could potentially save a lot of money if you get a Heloc to pay off your student loan debt. So let me know your thoughts. Let me know. Do you think a HELOC makes sense? Do you think you refinance or do some other things to lower your interest rate? I'd love to know. Go to thecollegeinvestor.com/episode 43 and let me know what you're thinking when it comes to using a HELOC for your student loan debt. All right, guys, I hope you found that interesting, and I will see you next time.